Welcome to our deep dive into distortion risk measures. In today's comprehensive video, we'll explore what distortion risk measures are, how they're applied in real-world scenarios, and why they're crucial in financial risk management. We'll also address common questions and clear up any misconceptions. To kick things off, let's define distortion risk measures. Distortion risk measures are a class of risk measures that transform the distribution function of losses. This transformation helps capture the risk preferences of decision-makers, providing a more accurate reflection of potential risks. Now, you may be wondering, why do we need distortion risk measures? Traditional risk measures like value at risk, VAR, and expected shortfall, ES, have their limitations. For example, VAR does not capture tail risk effectively. This is where distortion risk measures come into play. Let's consider a real-world example to illustrate this. Imagine an insurance company assessing the risk of potential claims. Traditional risk measures might underestimate the likelihood of extreme claims. By applying a distortion risk measure, the company can adjust the distribution to give more weight to tail risks, providing a clearer picture of potential high-loss scenarios. Here's a graph that showcases the difference between traditional risk measures and distortion risk measures. Notice how the distortion risk measure gives more weight to the tail end of the distribution, thereby providing a more accurate risk assessment. All right, time for a quick quiz. Why might an organization prefer distortion risk measures over traditional methods like VAR? They capture tail risk better. B, they're easier to calculate. C, they provide a detailed risk assessment. D, they're more widely accepted. If you answered A and C, you're correct. Distortion risk measures are favored because of their ability to capture tail risks and provide detailed risk assessments. Next, let's delve into some equations to get a better understanding. The distortion risk measure can be represented as, in this equation, ρ_g, x, represents the distortion risk measure of a random variable x. The function g is the distortion function, which modifies the cumulative distribution function f_x to reflect the risk preferences. To make things clearer, let's consider a simple example using a distortion function g, u, equals u squared. This quadratic distortion function highlights the weight given to tail events more than to central events. Now let's look at how to apply this practically. Suppose you have a portfolio with expected losses that follow a normal distribution. By applying the quadratic distortion function, we can see how the weighting shifts toward higher loss scenarios. Here's a line graph that depicts the difference in risk assessment between traditional measures and our quadratic distortions. You can see that tail events are given much higher probabilities with the distortion measure. This demonstration illuminates the advantages of using distortion risk measures for more reliable risk assessment, especially in extreme scenarios. These characteristics make them invaluable for industries like insurance and finance, where tail risks can have significant impacts. Moving forward, let's answer a question that often comes up. How do distortion risk measures align with regulatory standards? Modern regulations, like Basel III in banking, increasingly encourage risk measures that capture tail risks. Hence, distortion risk measures can help firms align better with these regulations. As we approach the end of this video, let's review the key takeaways. 1. Distortion risk measures adjust the distribution of losses to better reflect risk preferences. 2. These measures are particularly useful in capturing tail risks, providing a more comprehensive risk assessment compared to traditional methods like VAR. 3. Industries like insurance and finance benefit significantly from distortion risk measures, especially in meeting regulatory standards. Thank you for joining us on this deep dive into distortion risk measures. If you found this video helpful, please like and subscribe for more in-depth finance tutorials. We'd love to hear your questions and comments below. See you in the next video.